Welcome to the Explainer. Today we're diving into some really cool research all about how financial technology or fintech is shaking things up for businesses in emerging economies. Alright, so here's how we're going to tackle this. We start with the big question they were trying to answer, then we'll look at how they set up for study, what they actually found, and most importantly, why it all matters. Okay, let's jump right in. The whole study really boils down to one massive question. Can technology, specifically fintech, actually solve this huge global problem of businesses not being able to get the funding they need? And this isn't some small issue. For a ton of companies in emerging economies, not getting funding from a bank is sort of a deal breaker. Just grinds their growth to a halt. We're talking missed chances to invest, to innovate, and to hire more people. So here's what it gets really interesting. Think about how a traditional bank decides to give you a loan. They look at what researchers call hard data. The credit history, what assets you have to put as a collateral, stuff that other smarter, younger companies just don't have. But fintech lenders, they play a different game. They look at data, things like company online sales, their social media presence, their whole digital footprint. They feed all that into an algorithm that get a totally different picture of risk. And that right there is the potential game changer. And to figure this out, they didn't just, look at a handful of companies. We're talking about a massive data set here. Get this, almost 46,000 firms spread across 20 different countries over an 8-year period. The sheer scale of this thing is what makes the results so powerful. Okay, so how exactly did they set this whole thing up? I mean, it's one thing to say, hey, fintech is growing up on these companies, but it's a whole other challenge to prove that one is causing the other. And that took some really clever study design. First up, they had to figure out a way to pinpoint which businesses were the most desperate for cash. So they used this metric called external finance dependence, EFD for short. It's basically a score that tells you how much an industry needs to borrow money to grow, just based on how the industry works. A high tech manufacturer, for example, is going to need a lot more outside cash than, say, a local coffee shop. Okay, now this next part is absolutely crucial. It's the secret sauce of their whole method. To prove that fintech was the real reason for success, they use a statistical tool called a pixel effects model. So what the heck is that? Well, think of it like a science experiment in a garden. If you want to test a new fertilizer on one plant, you have to make sure you control for everything else, right? The amount of sunlight, the water, the soil. This model does exactly that, but for businesses. It digitally removes all the background noise, like how well a country's economy is doing on trends in specific industry, so they could zoom in and see only the effect of fintech. Super clever stuff. So why did success even look like this in the study? They tracked for many things. Two were about financial health, return on assets, and return on equity. Basically, how good is a company at making a profit? The other two were about real-world impact, value-added growth, and employment growth. Is the company actually growing and creating jobs? A really well-rounded view. Alright, so the stage is set. They have this huge data set and a super smart way to analyze it. So what did they find? This is where it gets really, really interesting. Okay, let's take a look at this chart. It's kind of a first peek at the raw data. That solid black line shows fintech lending over time. And whoa, you can see that massive boom and then a pretty sharp drop off. And if you look at the other lines, especially the value-added growth, it seems to kind of sort of follow a similar path, right? Peaking around 2017. But remember that statistical model we talked about? The one that filters out all the noise? Well, once they applied that, the picture became crystal clear. The link between fintech and company performance wasn't just a fluke. It wasn't a coincidence. It was real and it was significant. And this quote from the paper really just nails it. What they're saying is pretty simple. The companies that were most dependent on outside funding saw the biggest boost in performance, but only if they were in a country where fintech was a real option. It made a tangible, measurable difference. And here's the proof in the pudding, right on this table. That key combination they were testing, the effect of fintech on those cash-hungry firms, it was positive across the board. And not just a little positive, but statistically significant. We're talking better profits, more growth, and more jobs. Check, check, and check. It confirmed everything they thought. Okay, so we know it works, but why? How does getting a fintech loan actually translate into better performance? Well, the researchers dug into that too, and they found three main reasons. It really comes down to a 1, 2, 3 punch. First, and this is the obvious one, it gives companies cash to actually invest in things, new equipment, better software, you name it. Second, fintech lenders often have lower operating costs, which can mean lower borrowing costs for the businesses, freeing up even more cash. And third, those first two things lead to something economists call total factor productivity or TFP. It's a fancy term, but all it really means is that the businesses get smarter and more efficient at doing what they do. They get better at turning $1 of investment into more than $1 of value. And what's cool is that it's not just one type of fintech that's doing all the work. They broke it down and found that what peer-to-peer lending, P2P, is the biggest piece of the puzzle. Other kinds like balance sheet lending and even crowdfunding all play a positive role. The data points to something else that's really fascinating. The researchers found that fintech has less of an impact in places that already had a lot of bank branches. This suggests that fintech isn't just helping everyone, it's specifically stepping into a fill a gap where traditional banking is falling short. It's acting as a substitute. And that, of course, raises the $1,000,000 question. What does the future look like? Is fintech going to eventually replace the old guard, or will they figure out a way to work together? Alright, let's wrap this up and really hammer home the key takeaways from this STAR study. En resumen, primero, la evidencia es prácticamente innegable. La tecnología financiera, fintech, le da una gran ventaja precisamente a las empresas que más lo necesitan. Segundo, eso no se trata solo de números en una hoja de cálculo. Estamos hablando de un crecimiento real y tangible, tanto en el valor que crea una empresa como en los empleos que genera. Y tercero, sabemos cómo funciona. Al inyectar capital para la inversión, hacer que ese dinero sea más barato de obtener, más accesible para pedir prestado y, en última instancia, ayudar a que las empresas se vuelvan mucho más productivas. At the end of the day, what this study gives us is just powerful hard evidence that technology can tackle these huge, long-standing economic challenges. Fintech step in and help close a massive funding gap for countless businesses. And that really makes you think, doesn't it? What's the next big gap that technology is going to solve?